Welcome to Aviation Intelligence Weekly with Sarah and Mike, your guide to the aviation industry. Welcome back to Aviation Intelligence Weekly. I'm Sarah, and I'm here with Mike to break down Sun Country Airlines' 10K filing for fiscal year 2025. Mike, this is our first deep dive into SNCY's annual report, so we're establishing a baseline narrative here.
That's right, Sarah. Sun Country reported revenue of $1.13 billion, with operating income of $100.6 million, and net income of $52.8 million. What's notable is their cash position of $144.7 million against total debt of $323.3 million, all of which appears to be long-term debt according to the filing.
Let's get to our narrative classification. Without a prior filing to compare against, how do we establish what story Sun Country is telling?
The narrative has to be classified as unchanged because this is our first filing analysis for Sun Country, and we have no prior baseline to measure shifts against. However, what we can establish is a regional carrier narrative focused on leisure markets with a hybrid business model that includes both passenger service and cargo operations.
So, we're setting the baseline story here. What are the key elements investors should understand about Sun Country's positioning?
The filing presents Sun Country as a low-cost carrier serving primarily leisure destinations from their Minneapolis hub, with additional revenue streams from cargo and charter operations. Their financial structure shows moderate leverage with debt to total capital that we'll need to monitor as the baseline for future filings. Section 2. Material changes and pressure points. Retuschen 2.4
Mike, since this is our baseline filing, what are the most significant financial pressure points that stand out in Sun Country's structure?
The dominant pressure point is cost structure durability in a leisure-focused model. Operationally, Sun Country's dependence on discretionary travel spending makes their revenue base inherently more volatile than business travel-focused carriers. For investors, this means earnings will fluctuate more dramatically with economic cycles and consumer confidence shifts.
What does the filing tell us about their cost management approach?
The filing shows operating income of $100.6 million on revenue of $1.13 billion, which translates to an operating margin of roughly 9%. However, without management commentary extracted from the MD&A section, we can't determine their specific cost control strategies or how they view cost pressures going forward.
You mentioned leisure market exposure. How does that show up in their financial structure?
The second pressure point is margin sensitivity to seasonal demand patterns. Operationally, leisure carriers typically see significant quarterly variations in load factors and pricing power, which directly impacts unit revenues. For investors, this creates predictable seasonality, but also means that off-peak quarters can quickly turn unprofitable if costs aren't properly managed.
What about their balance sheet flexibility?
The third pressure point is liquidity management, with $144.7 million in cash against $323.3 million in long-term debt. Operationally, this 2.2 to 1 debt-to-cash ratio limits their ability to weather extended downturns or invest aggressively in growth opportunities. For investors, this suggests a more conservative financial posture compared to highly leveraged competitors, but also potentially slower expansion capabilities. Decreers, Section 3. Management commentary signals.
Let's talk about management's tone and strategic signals. What can we glean from their commentary?
Unfortunately, the filing extract shows no key management quotes were captured from the MD&A section, which significantly limits our ability to assess management's strategic direction or their view of market conditions.
That's unusual for our analysis. What does the absence of extracted commentary tell us?
The lack of extracted management commentary could indicate either relatively standard, non-newsworthy language in the MD&A, or it could mean the filing focused more on operational details than strategic vision. Operationally, this makes it harder to assess whether management sees headwinds or tailwinds in their key markets. For investors, The absence of strong directional language suggests either cautious optimism or management choosing to let results speak rather than providing forward guidance.
How should investors interpret this communications approach?
Without specific quotes, we have to rely on the financial results themselves to infer management confidence. The fact that they generated positive operating income of $100.6 million and maintained a cash position of $144.7 million suggests operational execution, but we can't determine if management views this performance as sustainable or if they see challenges ahead.
This really emphasizes the importance of the MD&A section for understanding management's strategic thinking.
Exactly. Operationally, management commentary typically reveals how they're positioning for competitive pressures, fuel cost volatility, and demand shifts. For investors, the absence of extracted strategic language means we'll need to watch subsequent quarterly filings more closely to understand management's market outlook and capital allocation priorities. In Weir's Section 4, Risk Disclosures. Dauer 1.5
Moving to risk factors, what new or escalated risks should investors be aware of?
Risk disclosures were largely unchanged from the prior filing, according to our analysis. Since this is our baseline filing for Sun Country, we can't identify newly escalated risks, but we can establish what their primary risk categories are.
What does that baseline risk profile look like for a carrier like Sun Country?
As a regional leisure-focused carrier, Sun Country's risk profile typically includes fuel price volatility, seasonal demand fluctuations, and competitive pressure from larger network carriers. Operationally, their Minneapolis hub concentration creates both efficiency and vulnerability. Weather disruptions or economic weakness in their primary catchment area can disproportionately impact operations. For investors, this geographic concentration risk is balanced against the operational simplicity and cost advantages of a focused hub strategy.
Any regulatory or industry-specific risks that stand out?
Without specific risk factor escalations noted in this filing, we're establishing that Sun Country faces standard aviation industry risks, including regulatory changes, pilot shortage pressures, and aircraft maintenance cost inflation. Operationally, smaller carriers like Sun Country often have less negotiating power with suppliers and lessors compared to major network airlines. For investors, this means cost pressures can be harder to mitigate during industry-wide inflation periods. Rutgers Section 5, Liquidity and Balance Sheet Stress. Need.
Let's dive deeper into Sun Country's balance sheet positioning. How does their financial structure enable or constrain their strategy?
The balance sheet appears to be enabling rather than constraining their current strategy. With $144.7 million in cash and equivalents against $323.3 million in long-term debt, Sun Country maintains reasonable liquidity for a regional carrier of their size.
How does that debt level compare to their operational scale?
With revenue of $1.13 billion, their debt-to-revenue ratio is roughly 29%, which suggests moderate leverage rather than aggressive financial engineering. Operationally, this level of debt service should be manageable given their operating income of $100.6 million, providing coverage for interest payments while leaving room for reinvestment. For investors, this conservative approach limits financial risk, but may also constrain growth acceleration compared to more aggressively leveraged competitors.
What about their cash position relative to operational needs?
The $144.7 million cash position represents about 13% of annual revenue, which provides a reasonable operational buffer for seasonal fluctuations and unexpected disruptions. Operationally, leisure carriers need sufficient cash to weather off-peak periods when load factors decline and pricing power weakens. For investors, this cash level suggests Sun Country can maintain operations through normal cyclical downturns without requiring emergency financing.
Any constraints or pressure points in their capital structure?
The primary constraint appears to be growth financing capacity rather than immediate liquidity stress. With debt already at $323.3 million, Sun Country's ability to fund major fleet expansion or route development may require either strong cash generation or equity financing. Operationally, this could limit their ability to respond quickly to competitive threats or market opportunities. For investors, it suggests a more measured growth trajectory rather than aggressive expansion. Durberstein, Section 6, Segment Analysis, 1.59.
Sun Country operates multiple business segments. What's driving their overall performance?
Unfortunately, the filing extract doesn't provide detailed segment revenue or margin breakdowns, which limits our ability to identify which parts of the business are performing strongest.
What can we infer about their business mix from the overall financial results?
With total revenue of $1.13 billion and operating income of $100.6 million, Sun Country appears to have a reasonably balanced business model, generating consistent profitability. Operationally, their hybrid approach, combining scheduled passenger service, charter operations, and cargo, likely provides some revenue diversification compared to pure-play scheduled carriers. For investors, this diversification can smooth earnings volatility, though it may also limit the upside potential during strong leisure travel cycles.
How important is understanding the segment mix for evaluating Sun Country?
It's critical for assessing both growth prospects and risk management. Different segments have varying margin profiles, capital requirements, and cyclical patterns. Operationally, charter and cargo operations often provide higher margins but less predictable revenue compared to scheduled service. For investors, the segment mix determines how Sun Country's earnings will respond to different economic scenarios and competitive pressures.
What should we watch for in future filings regarding segment performance?
Future filings should reveal which segments are driving margin expansion or contraction, and how management is allocating capital between passenger, charter, and cargo operations. Operationally, shifts in segment focus could signal strategic pivots in response to market conditions. For investors, segment-level metrics will be essential for valuing Sun Country's different business lines and understanding their competitive positioning in each market. Section 7. What to monitor next? In option 1.5
Mike, let's wrap up with your 4 key items investors should monitor in upcoming filings.
First, watch quarterly cash flow generation patterns, because it will confirm or contradict whether Sun Country's 9% operating margin is sustainable through seasonal cycles and economic fluctuations.
What about their cost structure evolution?
Second, watch unit cost trends and cost control initiatives in the MD&A commentary, because it will confirm or contradict management's ability to maintain profitability during leisure travel downturns or fuel price spikes.
And on the strategic front?
Third, watch route expansion announcements and fleet utilization metrics, because it will confirm or contradict whether their current cash and debt levels can support meaningful growth without additional financing.
Finally,
fourth, watch segment revenue and margin disclosure in quarterly reports, because it will confirm or contradict the sustainability of their diversified business model and reveal which operations are driving profitability.
those are concrete, observable metrics that will help build the Sun Country narrative over time.
Exactly. Since this is our baseline filing, these 4 areas will be critical for determining whether Sun Country can maintain their current profitability levels while growing their market presence, or if they'll face margin pressure that constrains their strategic options. Section 8, Outro, 30 seconds.
That wraps our analysis of Sun Country Airlines' fiscal 2025 10K filing. Remember, this analysis is for informational purposes only and should not be considered investment advice.
Thanks for listening to Aviation Intelligence Weekly. We'll continue monitoring Sun Country's quarterly filings to track how this baseline narrative evolves.
Until next time, keep watching the filings.